Welcome to Breaking News to Trading Moves. I'm your host, and today we're looking at a specific development within the healthcare sector regarding Johnson & Johnson.
Right. It's a headline regarding a potential divestiture that's really caught the market's attention.
Yeah, the primary news item here is that Johnson & Johnson is exploring a potential sale of its Orthopedics unit. That's DePuy Synthes. And the number attached to this deal is, it's substantial.
Very.
We're talking about a valuation that could top $20 billion.
$20 billion is the figure circulating in the reports right now. And just to provide context on that scale, DePuy Synthes generated approximately $9.3 billion in sales in 2025.
So we are looking at a transaction involving roughly $9 to $10 billion in revenue.
Exactly.
But the specific aspect I want to discuss first is the change in plan. Johnson & Johnson had a very different roadmap for this unit previously, didn't they?
They did, yeah. They had previously stated plans to separate this unit into a standalone company via a spinoff.
Right.
And the timeline they provided for that was 18 to 24 months. That was the original strategy communicated to shareholders.
And now that has completely changed.
The current reporting indicates a pivot. They are signaling a potential direct sale instead. The company is reportedly preparing financials and all the necessary documents for meetings with potential buyers in the coming weeks.
Why would they switch from a spinoff to a direct sale? Like, what is the whole rationale behind that decision?
The primary logic is just speed and cleanliness. A direct sale can be executed much faster than a multi-step spinoff.
Because a spinoff has a lot of red tape.
A lot of red tape. It involves regulatory filings, setting up a completely new board of directors, establishing independent management structures. It's just a lengthy process.
Right.
A sale, on the other hand, is a transaction that transfers the asset and brings in immediate capital.
Speaking of capital, if they sell for $20 billion, that is a very large amount of cash suddenly entering the balance sheet.
Which brings us right to the use of proceeds. Investors are going to focus heavily on what Johnson & Johnson intends to do with that cash.
They have a few options there.
They do. Stock buybacks, debt reduction, or reinvestment into higher growth segments of their business. So things like their pharmaceutical pipeline or other medtech innovations.
It effectively swaps a lower growth asset for cash that can be deployed elsewhere.
That is the operational logic. But there is also a specific factor regarding the asset itself that makes a sale viable right now, which is the litigation status.
You're referring to the liability issues they've had.
Yes. Johnson & Johnson has resolved nearly all nationwide ASR HIP claims. This is a highly critical detail.
Why is that resolution so important for a potential buyer?
Because it lowers the uncertainty. In finance, we call this removing the litigation overhang. When you resolve those claims, the asset becomes much easier to finance and underwrite.
So the buyer knows exactly what they're getting into.
Exactly. A buyer can value the business based on its actual cash flow without having to price in some large, unknown legal liability down the road.
So the asset is cleaner, the price is set around $20 billion, and the company wants to move quickly. That is the context for you, the listener. Now, let's look at the market implications. We have a list of winners and losers based on this news. Let's start with the winners.
The first category of winners are the direct orthopedics competitors.
So these are the direct rivals to DePuy Synthes.
Correct. The logic here relies entirely on the disruption caused by a sale process. Johnson & Johnson is entering a transition period. Whether it ultimately is a sale or a separation, it creates internal distraction.
How does that distraction translate to a win for a competitor, though?
Well, in the medical device field, relationships are paramount. Surgeons really rely on their specific sales representatives. If the sales team at DePuy Synthes is concerned about the ownership change,
Or about their future employment, right?
exactly, their focus may drift. Rivals can use that uncertainty to swoop in and win hospital contracts and surgeon loyalty.
They can pitch stability while DePuy is in flux.
That's the playbook. So the specific names to watch here are the large competitors. First, Stryker. The ticker is SYK.
SYK.
And the other major player in that space is Zimmer Biomet. The ticker is ZBH.
ZB'd.
Both SYK and ZBH stand to gain market share if DePuy Synthes loses focus during this transition.
Moving on to the second category of winners, a transaction of this size obviously requires a lot of financial infrastructure.
It does. Which brings us to the deal ecosystem and capital markets.
The banks.
The investment banks. A $20 billion carve-out drives substantial advisory fees. You need banks to manage the entire sale process. Furthermore, there is the financing activity.
Because whoever the buyer is, they likely need to borrow money to fund a $20 billion purchase.
Precisely. If a buyer is paying $20 billion, they will almost certainly utilize syndicated debt issuance. This generates massive fees for the banks arranging that debt.
Which institutions are best positioned for this?
You look at the historical leaders in advisory and financing. Goldman Sachs is a key name. The ticker is GS.
G.
And JP Morgan Chase. The ticker is JPM.
JPM.
These firms, GS and JPM, benefit directly from the mechanical aspects of executing a deal of this magnitude.
Let's talk about the third category of winners. This relates to who might actually buy the asset.
We discussed earlier that private equity is seen as the most likely buyer group here. So the third category is private equity.
Why would private equity want an orthopedics unit? It is generally considered a mature, slower growth market, isn't it?
It highlights their appetite for durable cash flow platforms. DePuy Synthes generates over $9 billion in sales. That is highly consistent revenue. And private equity firms value that stability because it supports the leverage they use to buy the company in the first place.
It is a straightforward cash flow play.
Yes. And if they pursue this, it validates the medtech sector for private investment broadly.
Who are the firms with the actual capacity for a $20 billion deal? There aren't that many.
You have to look at the largest alternative asset managers in the world. Blackstone is a primary candidate. The ticker is BX.
BX.
And KKR. The ticker is KKR.
KKR.
If BX or KKR are involved, it puts their capital to work in a very major way.
So to recap the winners for you, we have the competitors, SYK and ZBH, benefiting from distraction. We have the banks, GS and JPM, earning fees. And we have the private equity firms, BX and KKR, deploying capital.
That covers the long ideas.
Now let's look at the other side of the ledger, the losers, or rather, the risks. We start with the seller itself.
Johnson & Johnson near term.
Why is this a risk? I mean, if they get the cash, isn't that a positive for the balance sheet?
It creates near-term complexity. Even if the long-term focus is growth, the stock can wobble due to unknowns.
What specifically are the unknowns the market dislikes here?
The final price is one. Then there is tax leakage, how much of that sale price goes to the government, and crucially, stranded costs.
Explain stranded costs in this context.
When you remove a large unit like DePuy, there are corporate overhead costs. So HR, IT, legal departments. These were previously supported by DePuy's revenue. Those costs remain with Johnson & Johnson even after the revenue is gone.
Oh, so they're paying for infrastructure they no longer need.
Exactly. That can weigh on margins until those costs are addressed and scaled down.
And then there's the obvious question of replacing the actual revenue.
Correct. Investors will ask what replaces that $9.3 billion in annual sales. Until that is clear, there is uncertainty baked into the stock.
So the ticker is JNJ. You also mentioned Medtronic in this category, though.
Yes. Medtronic faces similar scrutiny regarding its portfolio mix. The ticker is MDT.
MDT.
When J&J sells a unit specifically to improve its growth profile, the market looks at peers like MDT and evaluates their lower growth segments with a much more critical eye.
So J&J and MDT represent the near-term risk in large-cap medtech right now.
Correct.
Let's move to the second category of losers. We talked about private equity buyers, but what if a strategic buyer steps in instead?
A strategic buyer would be another large medical device company.
Why would they be placed in the loser category?
It comes down to the market reaction to the acquisition. If a large medtech peer bids, the market worries about two distinct things. Paying a peak multiple and integration distraction.
Paying too much. The classic winner's curse.
Exactly. And the integration itself is difficult. Merging supply chains and sales forces takes management's attention away from the core business.
Who are the potential strategic buyers that might face this risk?
Boston Scientific is one. The ticker is BSX.
BSX.
And Baxter International. The ticker is BAX.
AA.
If reports surface that BS or BAX are bidding, their stock prices could face immediate pressure due to these integration and valuation concerns.
Finally, the third category of losers, the smaller ortho players.
This is a consequence of the deal outcome itself. Whether DePuy is bought by private equity or a strategic competitor, the result is likely a much more aggressive entity.
In what way? How does the ownership change make them more aggressive?
A private equity owner will push for heavy cost-cutting and commercial efficiency to maximize cash flow. A strategic owner would create a competitor with massive scale and distribution power.
And that puts pressure directly on the smaller companies in the space.
It creates pricing pressure. Smaller players may struggle to compete with a revitalized, leaner DePuy Synthes fighting for market share.
Who are the smaller players to watch in this scenario?
And Reshine is one. The ticker is HSIC.
HSIs.
And Owens & Minor. The ticker is OMI.
OMI.
Both HSIC and OMI could face a more difficult competitive environment as a direct result of this sale.
So to outline the risks for you, we have J&J and MDT on execution and sentiment, BSX and BAX on acquisition risk, and HSIC and OMI on competitive pressure.
That sums up the downside risks perfectly.
We have the headline and the players. Now, what should you be watching next? What are the forward-looking indicators?
There are 4 key variables to watch moving forward. First is the buyer type.
Private equity versus strategic.
The difference really matters. A strategic buyer might pay more because they can realize synergies combining operations to save money. Private equity cannot do that in the same way.
But the strategic buyer brings that integration risk we just discussed.
Correct. So the identity of the bidder changes the entire narrative of the deal.
What is the second thing to watch?
The structure. Will it be an outright sale of 100% of the unit?
Yeah.
Or a partial sale? Or perhaps a staged separation where they sell pieces over time?
How does the structure impact the stock?
It determines the cash inflow. An outright sale brings the maximum amount of immediate cash to Johnson & Johnson.
And that cash leads directly to the third point.
Capital return. This is likely the most vital factor for current J&J shareholders.
Buybacks.
Exactly. If there are hints of accelerated buybacks, that can move sentiment quickly. If the company commits to returning a large portion of the sale proceeds to shareholders, it offsets the earnings dilution from losing DePuy's revenue.
And finally,
Timing.
the timeline seems to have accelerated quite a bit from the original plan.
The CFO previously indicated that no material update was expected until mid-2026.
That is still a long way off.
It is. Therefore, if we get any confirmation or official announcement earlier than that, it acts as a major catalyst.
It would be a surprise to the market.
Yes. Earlier confirmation means the deal is progressing faster than the previous guidance suggested.
Let's summarize the situation. Johnson & Johnson is exploring a sale of DePuy Synthes, potentially valued at over $20 billion. This represents a direct change from their previous spinoff plan.
It is a high-impact headline because of the sheer size and the strategic implication for the company's revenue mix.
The winners include competitors like SYK and ZBH, banks like GS and JPM, and private equity firms like BX and KKR.
And the losers or risks include the parent company J&J and peer MDT due to uncertainty, potential strategic buyers like BSX and BAX due to integration risk, and smaller players like HSIC and OMI due to competitive pressure.
If confirmation of bidders or structure arrives, we should expect relative moves in these peers.
The market will react to the certainty once the exact details are known.
Before we wrap up, I want to leave you with a final thought to mull over. If we see Johnson & Johnson successfully shed this legacy asset for a premium, consider how this might force the broader market to reevaluate the growth expectations for the entire medtech sector over the next decade. If the big players are paring down to focus only on high-growth areas, the baseline for what constitutes a successful medical device portfolio might be moving higher.
It is certainly a trend worth watching.
We will continue to monitor the wires for upvotes on this potential transaction.
It will definitely be a key storyline for the sector in the coming weeks.
Before we sign off, a disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We will see you next time.